Very good morning, ladies and gentlemen. It's my honor and privilege to welcome all of you as the regional president of the Indo-American Chamber of Commerce, particularly in the context of this very significant interactive session on the India-United States tax treaty. This treaty stands as a cornerstone of the economic relationship between our two great nations, facilitating trade, investment, and fostering bilateral ties. As we gather here, and thank you for being here with us both in person and virtually as well. I thank you all. I know it must be a very busy working day. So thank you for your commitment to make the time and being with us here. As we gather here, we recognize the importance of this treaty in providing a framework for businesses to operate seamlessly across borders, while also ensuring that fairness is maintained and it prevents double taxation as well. The Indo-American Chamber of Commerce has always been a very strong proponent of policies that promote trade and investment between India and the United States on a bilateral basis. And the tax treaty is a very fundamental component of this whole structure, so to speak. In today's dynamic and global economy, our tax treaty must remain adaptive and responsive to the evolving needs of businesses and the ever-changing landscape of international commerce. We must address emerging challenges such as digital taxation, transfer pricing, and the complexities of cross-border investments, while also capitalizing on opportunities for greater cooperation and collaboration. This interactive session provides a valuable platform for all of us stakeholders here, for both nations to engage in constructive dialogue, share insights, and chart a course for the future of a tax treaty. By working together, we can identify areas for improvement, streamlining processes, and ensure that the treaty continues to serve as a catalyst for economic growth and prosperity. I encourage all the participants, both in the room here and also those who have joined virtually, to actively participate, exchange ideas, and contribute to the collective effort to strengthen our economic partnership. Let us seize this opportunity to reaffirm our commitment to our vibrant Indo-American business relationship built on mutual respect, trust, and shared prosperity. I am extremely thankful to our host here, Mr. Rahul Kapoor, Managing Partner, RKCA and Company LLP, who will be helming this session. And with that, let me hand over to you, sir.
Thank you, Arun. Thank you. I welcome all of you to this interactive session on the Indo-American Tax Treaty. First and foremost, my thanks to Arun and to the Indo-American Chamber of Commerce for giving RKCA this opportunity to share our knowledge with all the members of IACC. I hope that this session will be a very educative and informative one for all of you. Let me introduce my colleague, Kiran. She's an integral senior member in our international tax team, and she's been with the firm for about 15 years. Of course, Arun just told me a little while ago that he's been with AT&T for 24 years. I was like, did I hear that right? 24 long years. Great. And I must share another thing which he said about his American employer. He said, I have never felt like an employee at AT&T. I've always felt like I'm part of the big AT&T family. And they've always given me the, the respect and the liberty to, to feel like I'm an integral part of the team.
Absolutely.
Great. So as Arun said, the tax treaties are a very important legislation, if I may, for want of a better word, which eases the cross-border, the taxation on cross-border transactions. So let me start with a little introduction to RKCA. Our firm was, till 6 months ago, it was called RKCA. It was a bit of a tongue twister, and most people used to call it RKCA anyways. And since we now got the name, it was not available earlier, we changed it to RKCA and Co. from RKCA and Associates. So these are some of the things that our firm does. So on the right, top right, you can see India entry strategy and international taxation. Then there's auditing, income tax, legal services and corporate compliance, FEMA, RBI issues, financial process outsourcing, transaction advisory, which is now a big part of our practice, and of course, goods and service tax. And we have clients from various industries, including pharmaceuticals, entertainment, IT. We work with a lot of startups. Then we have film production companies, hospitality, software, e-commerce, e-gaming, and so on. So we've been in practice, the firm was established in 1985, and we have a very stable team and a very committed team with a total strength of over 100 team members, which includes chartered accountants, company secretaries, MBAs, lawyers, and so on. So I'll move on quickly to the next slide so that we can start the real topic of today, which is the tax treaty between India and America. So firstly, let me tell you that we have, for ease of understanding, we have modeled this presentation on US companies coming into India. So all the examples you will see here will be a US company coming into India. Okay, but being of bilateral nature, it similarly applies to Indian companies going abroad. Okay, of course, there could be some variations in local taxation laws in the US, but as far as the treaty is concerned, it treats one member of the treaty at the same level as the other member. So if there is, let's say, certain income to be taxed, which is earned in America to be taxed in India and vice versa, the treatment will be at par. So a little background of the treaty itself before we go on to this slide. So why did the treaty become necessary? As trade grew and became global, companies started setting up businesses in other countries. Similarly, individuals started moving a lot more frequently to other countries to find employment or to provide consultancy or to do other, freelancing work. So there was a lot of cross-border movement. Now, so I'll start with this slide because it matches more with what I'm saying right now. So typically, taxation is levied based on two main criteria. The criteria number one is residence of the person earning the income. And the second criterion is residential status. So where is the person resident? In the case of USA, it changes to, it's more citizenship and green card based than merely residential status based. Because the US taxes all its citizens on their global income. And the same is also true for all people holding a green card. So taxation is, I come back to the, what I was saying earlier, taxation is based on residence. Like if I'm a resident of India, I'm living in India for more than X number of days in a year as prescribed by the Income Tax Act of India. And the second basis is the source of the income I'm earning. Suppose I, being a resident of India, earn an income from the US. There will be an incidence of tax in both places. US will say we will tax it because this income has its source in the US. And India will tax it because I'm a tax resident of India. Okay, similarly, when a US company, so if you can quickly read this, where a taxpayer is resident in one country, has source of income in the other, it gives rise to double taxation. Because both the countries want to tax the person, that income. Right? So what tax treaties do is they provide the framework. How do they prevent double taxation? They provide a framework where the tax on an income which would otherwise get taxed twice is not taxed twice, but the taxes are either shared by both the countries in a stipulated manner as agreed within the treaty, or sometimes it is not taxed at all in one country and only taxed in the other country, right? A good example of that would be rental income. So rental income from a property in India is only taxed in India, even if it is earned by somebody who's living in the US. Okay, so I mean, we'll come to all those heads of income later as we go along. So now let's talk of corporate entities or business entities. When they come to India, how do they do business in India? There are several vehicles by which they can start working in India. The first one, as you can see on the slide, is by setting up a subsidiary in India. So they will have a company whose shares are held, majority of whose shares are held by the US entity. It could be wholly owned subsidiary, or it could be a majorly owned subsidiary, not a fully owned subsidiary. So this is one. The next one is a branch. So you set up a branch office in the other country. So the US company can set up a branch in India. The third one is, which is very common, is especially now since there's a lot of infrastructure development going on in our country. So a foreign company, a US company would come to India to take up a big contract, say construction of a dam, right? So then they would set up what is known as a project site or an installation site in the country. Okay, and of course, there are certain criteria around this as to when, after how many days, or what should be the duration of the project for it to become taxable income in India. So you make the dam in India, you are a US company, you've come to make a dam. It's just a temporary or, it's not an ongoing project. It's just limited to setting up the dam or making the railway bridge, etc., or a tunnel, and then going back to your country. But in spite of that, it's a vehicle by which you come and work in India, but it can also be taxed in India. Then the fourth one is a liaison office, also known as loosely as a representative office. So instead of setting up a full-fledged branch or a subsidiary, if you just need to, for example, test the waters in a country, you want to first send out a team who can check out the Indian economy and see how viable it is for you to set up a full-fledged branch. Then what do? You set up a liaison office, which does not do any commercial activity, which does not buy and sell, which does not manufacture. It is merely the parent entity, parent companies, eyes and ears. It comes to India, it checks out the market, does market studies, and so on. So it does not do any profit-making activities or commercial activities. The last one is by appointing an agent in the country. So you don't need to come. Many companies do that. You set up an agency. I give you the agency of my, my work or my services or whatever. Yeah. So the tax rate in the US for corporates is approximately 21%. And the tax rate in India is approximately 25%, the general rate. So if a US company is to be taxed in India for income earned in India and in the US because it's a US company, then it would end up paying 46% tax. As you can see there, 46% tax. 21 in the US, 25 here. And in the case of some other countries, the taxes are much higher there. So it ends up being, over 50%, sometimes 55%, which will, of course, kill the business. If you have to pay 50%, 55% of your income as taxes, then, you'll be left with very little funds to do business with. So we've already covered this. So the topics that we are covering today in our presentation are the following. Permanent establishment, very, very important foundational concept for tax treaties. Then the concept of business connection as given in the Indian Income Tax Act. Then we'll be covering dividend income, royalty and fees for technical services income. And of course, as I said, the context here will be dividend income earned by a US entity, individual or company from India. Similarly, royalty earned from India or fees from technical services or capital gains arising in India. Then we'll shed some light on tax credit availment, because if tax is deducted in one country, you get the credit of that tax, which you have suffered in the other country, in your home country. So if a US company, say, earns some dividend in India and has paid X amount of tax on it, then that tax, now the US end will also levy the tax on the dividend because it's earned there. But they'll give them credit for the tax they have paid in India. That is how double taxation is avoided. Whatever you've already paid in India, we give you credit for that. Right? You'll understand it better as we go along. Then the tax treaty versus Indian Income Tax Act. Then a little bit on expat taxation, which coincidentally we would like to, cover as a separate topic. Nilu at some time in the future, because a lot of expats have concerns on how they get taxed in India. What are the things they can do to avoid getting taxed in India in a legitimate way, of course, goes without saying. So we'll cover that in detail, but for now we have covered, that in brief. And the last one is dependent personal services and director's fee. So this is a very crucial aspect, because once a foreign company sets up what is known as a permanent establishment as defined in the tax treaty, then the entire income earned by that PE will be taxed in India, right? Not only will it be taxed in India, not only will it be taxed in India, it'll be taxed as a foreign company's income. So it'll attract the highest rate of tax. If you can see the bottom line, right at the bottom, the rate will be 40% plus surcharge plus cess. So it comes to roughly 42.5%. So this is very important, because every company needs to ensure as far as possible that the activity it is doing in India cannot be covered by the definition of permanent establishment. Because if it does get covered, then you get taxed at 42%. Right? So what is a permanent establishment? It's a fixed place of business through which the business of an enterprise is carried on. So it has to be a fixed place, which you will also see in points 1, 2, 3, 4, 5. And then a PE could be a branch, it could be an office you've set up here, it could be a place of management, which is also an office, but just to define it further, workshop, factory, etc. It could also be a, like we said, project office or installation office. So when does an entity or an office or an activity in India carried out by a foreign company, a US company, when does it become a permanent establishment, a PE? The criteria, the 5 criteria are given on the screen. The first one is it is carrying on business in India. So the activity has to be business activity, cannot be a non-business activity. There is like a charitable activity that would not qualify as a PE. The second one is it should have a place of business, which essentially means it should have a tangible place, not just a virtual office or something. Then that should be its own office. It shouldn't be like, where you can say this office is mine. I run it the way I like. Broadly speaking, just to tell you in layman terms. The fourth one is the place must be fixed. And the last one is that the business is carried on from that fixed place of business. So there is a place, you carry on business from that place. It's not like you have a place, let's say you have a liaison office, but your business is carried on somewhere else. Then it does not qualify. So you have a place, it is fixed, you're carrying on business activity from there. And if it meets all these five criteria, it becomes a permanent establishment.
Land is it on rental or
It could be on rental also. Good question. Yeah, it could be on rental also, as long as it is your rented office. So what are the types of PEs? The first one is a fixed place of business through which the business of a US company is carried out. Right? Now, again, in this, there are two situations, two scenarios. One, where it is doing income generating activities, which means business activities. And the other, which is non-business, could be auxiliary activities, it could be market surveys, it could be some other type of, like as a charitable or something like that, which is not a business. So then it is not a PE. Although it is a fixed place, it is not a PE because it's not carrying out any business activity or income generating activity. The second type is a subsidiary. Now, when a US company sets up a subsidiary company of which it owns the majority of the shares, that company, generally speaking, is an Indian company and it cannot be taxed as a PE. So as you can see, for example, your company in India will not be a permanent establishment of your US company.
Correct.
Because it's a separate legal entity in which the shares are wholly held by the parent company in the US.
Correct.
But being a subsidiary, it is a separate legal entity incorporated in India. So for all intents and purposes, for taxation purposes, it is not a permanent establishment of the US company. It's a separate Indian legal entity. Right? There is an exception in this, though, which we will come to later. That is a company which is a subsidiary, but it is a dependent agent generating income only for its US parent. It's a peculiar situation, but it does arise sometimes. The next one is an agency PE. So if you have a dependent agent in India, so you have a dependent agent, which is defined in the next slide, then it becomes a PE. Dependent agent is, we'll come to that later, but it's most, broadly speaking, it's a person who's only working for one US entity and is totally dependent on that US entity for its business. Right? And if it's an independent agent, like there could be an agent who's taking up multiple agencies of various companies from all over the globe or all over America, then it is not a dependent agent. So like an agent working for some US company in India cannot become a US company. Right? He's just an agent who's independent in nature. So therefore, he's not a permanent establishment. Then in the case of installation, like we had said earlier, installation PE includes project sites, building sites, construction sites, assembly projects. So they become a PE if the activity continues for more than 120 days in any 12-month period. So if they do any activity for more than 120 days in any rolling 12-month period, then they become a permanent establishment. So if a US company comes to India, takes up some, say, railway, some railway line laying project, track laying project, and it completes the work in, say, 90 days or 100 days, then it is not a PE. That income will not be taxed in India, because it is not the PE's income. It is a US company's income, even though it is earned in India, because it doesn't have a PE in India. I mean, it will not be taxed in India, stand correct. I mean, I would just like to clarify. It will not be taxed as a PE, which means not like a foreign company, right? But if it continues for more than 120 days, then it becomes a foreign company to be taxed at 42%. Okay, a service PE is when somebody comes and provides services in India, okay, through its employees or personnel. This is a very, very important one. We'll be discussing it in detail later. So if the activities of that service being provided, if it continues for more than 90 days in any 12-month period, or the services are performed for a related party. This is a very important one, because this covers people who are coming from American companies to give services to Indian companies, Indian entities. right? And this is peculiar to the Indo-US Treaty only. Most treaties with the developed world in between India and the developed countries do not have this provision. So when does a person become a dependent agent and therefore a PE? He becomes a dependent agent, and a person here means any entity, company, firm, etc. So the person becomes an agent. Yes, sir.
If it is the service provided to a related party, then there is no time limit.
Then there is no time limit.
Even for a fee.
Yes, exactly. Yes, exactly. That is why it's a very, very important, peculiar, and very, shall I say, dangerous provision. So, person who's not independent, firstly, he should not be independent. Secondly, he's acting on behalf of the company and habitually exercises an authority to conclude contracts. So it's like as if the US entity has given him full powers, free hand, that come on, you conclude contracts, take up any business on our behalf. So you are, doing it on behalf of the US company. So you have that authority. Okay, it's not like you are totally dependent on the decisions from the US company. Habitually maintains in India a stock of goods from which he regularly delivers goods or merchandise or secures orders in India. Okay. And the last one is an exclusion. Says, provided the activities are not of a preparatory or auxiliary nature. So they have to be in the nature of doing business, securing orders on behalf of the US company. So this company or individual or LLP, whoever is that dependent agent, will now become a PE of the US company. So there are some exclusions from what we have just spoken about in the definition of PE. And the exclusions, you can see it on the screen. Number one is where you're solely doing storage or display. Okay, storage or display, not selling. Number two, if you're just maintaining stock of goods for the purpose of processing by another enterprise. Sometimes the US company is getting something manufactured, say in the pharma world, by another pharma company. And there's another guy who's just storing the goods for them so that they can be given to that manufacturer, contract manufacturer. So then it's not a PE. Then, of course, solely for procurement, but not sale, and for collecting information, or maintaining a fixed place only for advertising. So these are auxiliary. All other are auxiliary because they are not hardcore business activities. Advertising, supply of information, scientific research, and so on. Now, this is a concept under the Indian Income Tax Act. Okay, so the Indian Income Tax Act says, what does it say? It says any income accruing or arising in India will be taxed in India, right? So how do you determine whether the income is arising or accruing in India or not? So one of the criteria by which you ascertain whether his income is accruing or arising in India or not is a business connection, the concept of business connection. So what is a business connection? It could be a dependent agent, as we have discussed earlier. And there's another one which has been added recently. This is significant economic presence. So this is mainly to cover companies who don't have a fixed place, but they have a significant economic presence, like online companies. Now, how do you tax, say, YouTube, which is Google? How do you tax? They don't have a fixed place of, if they don't have a fixed place of business from which they are earning the income. They are earning the income from YouTube being, being beamed all over the world, including India. So they may or may not have a fixed place of business. Twitter may not have a fixed place of business, and so on. So all these companies which can be accessed online. So to cover that, a new definition of business connection has been added, which is significant economic presence. So we just saw in the previous slide, there are two business connections. So we are now discussing the first one in detail. Dependent agent. Very important. Make sure as a US company that you never appoint an agent who can be categorized as a dependent agent. Right? So what is a dependent agent? So he habitually plays a principal. We've already covered this partly, but just for the sake of more clarity. So he plays a principal role in concluding contracts in the name of the US company. Now, this is a bit different from the previous slide because this is as per the Indian Income Tax Act. Now, Indian Income Tax Act says if a person habitually plays a principal role, in the earlier one it said that was from the treaty that he has the authority to conclude contracts. Here they don't say authority to conclude contract. They say if he habitually plays a principal role in concluding contracts, he may not have the full authority, absolute authority, but he plays a principal role. Okay, in concluding contracts in the name of the US company. Even that one said, that one also said on behalf of the US company, right? Or the provision of services or transfer of ownership or granting right to use property either owned by the US company. So it's not just contracts, but it is also on behalf of the US company providing the services or transfer of the ownership or granting right to use a property which is owned by the US company, which could be an oil rig owned by the US company. It could be, some other scientific equipment or something like that. So if he has a right to conclude contracts on behalf of a US company or allow use of the US company's assets, then also he becomes a dependent agent. And the last one is common with the tax treaty, habitually maintains in India stock of goods, right? And of course, the very last one is secures orders in India on behalf of the US company or any other connected foreign company. So it means that if there's a US company, he's procuring goods for it, but he's saying, oh, I'm independent because there's another company I procured for. But that other company is like a group company of the US company. Then again, he becomes, so they're trying to cover a situation where a person is looking for one group of companies, although legally they are separate US companies. So he cannot say, I'm working for 10 companies. Therefore, I'm not a dependent agent. They say, no, you're a dependent agent because all the companies you're working for are connected foreign companies.
So I do have a question.
Yes, sure.
As it relates to PE. So let's say there is a US company whose Indian entity is deemed to be a PE. So the 42% tax would apply to the earnings of the PE in India? Or is there a risk of some of the earnings of the parent company also brought into the ambit of taxation in India?
There's a very common saying. It says, don't judge a person by his answer, judge him by his questions. It's a brilliant question, brilliant question. So the fact is that the income of the the income of the US company, if it can be connected to the PE, that part will also be taxed in India. So that is the danger.
There's a risk because
big risk.
It could be nebulous.
Yes, nebulous. And, sometimes a dependent agent could be an Indian company, which is being taxed in India anyways on its P&L. This is my taxable profit, I pay the tax. But if the US company is earning something through that activity of the PE, that income can also come under the ambit of Indian taxation.
India attribution, these are sort of archaic. In my opinion, the root in tax rules, which gives out discretionary powers to the rate. And that unfortunately is working on a different set of rules. Until such time that those rules get unified.
Yeah, agree with you. It is very nebulous. In fact, when you try to tax somebody who's sitting in the US, this income is attributable, then he will say, no, but that expense I incurred there is also attributable. So it becomes very complicated.
Thank you. Thank you.
Thanks. So before we go to this slide, let me tell you that it does not apply to the Indo-US treaty because this SEP has not been adopted by the Indo-US treaty as of now, till now. Okay, but we are going to tell you what it is because this is the way it's going to pan out in the future. So what is a significant economic presence? Any transaction in respect of any goods, services, property carried out by a non-resident with any person in India, including provision of download of data or software in India. So there are two thresholds here. The aggregate payments arising, which you can say revenue generated from those transactions, exceed rupees 20 million, which is rupees 2 crores. So if any of the, the companies, like I said, YouTube or Twitter or somebody or Facebook, if they earn more than 22 crore rupees in a year, then they get covered by the definition of significant economic presence. And going forward, God knows how it will ever be implemented and how the attributable profit will be computed. But this is the way it is right now in the Indian Income Tax Act. And the second criterion is it has more than 300,000 users in India. Okay. Okay, now we come to dividend income arising from India to a US person, US entity, company, individual. So how does it get taxed? Dividend paid by an Indian company to a US company is taxable in India, obviously, because it is sourced in India, right? So how does the treaty provide the relief from double taxation? The treaty says that the tax share of India from this dividend will be 15% if the US company holds more than 10% shares, or you can say voting rights or equity shares with voting rights in the Indian company, which means it has a substantial shareholding in the Indian company. It's not just doing some portfolio investment sort of thing, or has a very minuscule holding. So then the rate will be 15%. So what will happen when the Indian company pays dividend to such a US company, which holds more than 10%, then 15% withholding tax will be withheld by the Indian company, which is paying the dividend, and paid to the Indian government. It's like TDS. Withholding tax is the equivalent of TDS. It's called TDS in India, but in most countries and globally, it's called withholding tax. So 15% you withhold, balance dividend you pay to the person in the US. Then what happens in the US? He'll be taxed in the US at US tax rates on dividend. Suppose the US tax rate on dividend is 20%. Now the guy will declare his dividend income in the US because he's a US resident. He'll say, I have to pay 20 rupees on 100 rupees, 20%. But I've already paid 15 in India. So give me tax credit for that. So net, he only pays the balance 5 rupees or 5% in the US. So there's no double taxation. He's just been charged 20%, which was the home country's tax rate. Right? And if it's any other company in which you don't hold 10% or more, then the withholding tax rate is 25%. You pay it, if somebody earns dividend from India, they pay 25% tax rate. Right? And of course, tax credit will be available in the US. The last one again says that if it's a PE, then of course it's taxed as business income of a foreign company. The next very common type of payment which goes from one country to another when cross-border businesses are taking place is royalty income. When big companies, they give out their not ESOPs. Royalty is like you have a branded product or you have a technology, patented technology, and you've given it to somebody. So then it becomes a royalty, right? Let's say if McDonald's opens franchises here, or say a big brand of apparel, say Gucci opens stores in India, then they take a royalty. They say part of the income we learn from you because we've given you the permission to set up a Gucci store or a Louis Vuitton store is going to come to us as royalty. So, and it's usually based on turnover. So it could be 1, 2, 3% of turnover.
The reason that cost here.
Yeah, it does add up to the cost. It does. But that's not the real reason. The real reason is import duties. So there's a lot of import duty. So first they pay the import duty. Then when they set up the store, Gucci says, give us franchise fee also, 3% royalty. So that also gets added. Then they also take some admin costs. Then they say to set up the store, you have to take everything from us or from our vendors. So you go to some Italian company and you buy the furniture for your store. It's all Italian furniture, which can, of course, now easily be made in India. But, they impose these conditions. So therefore, the cost goes up. Yeah. Okay. So royalty payments, what is the withholding tax on royalty payments? We'll go through this very quickly. What's the time, by the way? So we have another 20 minutes, roughly. Okay, so if the royalty is in the nature of a license fee, then it is 15% withholding tax. If it is for use of industrial, commercial, or scientific equipment, then it is only 10%. Okay, and FTS, of course, is fees for technical services. Now, there are two types. Those which are connected with use of industrial, commercial, or scientific equipment, okay, which have been bought under royalty or taken under royalty, then it is 10%. And when it is to make available technical knowledge, experience, skill, know-how, or consist of development and transfer of technical design, then also it is fees for technical services. And that one, because it's not connected to scientific equipment, etc., attracts 15% withholding tax. And then the same routine is followed. Withholding tax is deducted in India. And then when you file your US taxes, you declare the entire income. Tax payable in the US is, as I said in the previous example, 20 rupees, but 15 has already been deducted and paid in India. So the balance 5 is payable in the US. That's how it works. Okay, capital gains, very important. So how is capital gain taxed in India? Obviously, capital gain has to arise in India, which means in a general sense, it arises from sale of a property situated in India or shares of an Indian company. You sell the shares of an Indian company, where does the capital gain arise? In India. You sell an Indian property, you have some land in India, you sell it, you have a business in India. Of course, mostly when you sell a business, you sell the shares. So that is arising in India and therefore taxable in India. So very quickly, in the interest of time, long-term capital gains, if it is sale of listed equity, the tax rate is 10%. Right? You're taxed at 10%. If it is any other, this is long-term, then it is 20%. And if it is short-term, which means held for a shorter period, then we'll come to the period in the next slide. If it is unlisted equity shares, 15%. Any other, you have to pay the normal tax rate, which is applicable to you. In the case of short-term capital gain, which is not an unlisted equity share, or an equity-oriented mutual fund, you can see at the bottom. Some things are at par with listed equity. Of course, when it is long-term, you also get the benefit of indexation. And the ultimate tax is levied on sale proceeds minus indexed cost of acquisition. Now, this is again very, very interesting and something which everybody in the US should know. Now, this is, I'll go to the next slide so that I can explain it better. Now, you see, if you sell the shares of a US company, okay? So let's say one resident of America, of the US, is selling the shares of a US company to another resident of America. The entire transaction is happening outside India. The shares being sold are also of a US company. yet they can be taxed in India. Now, these provisions were mainly highlighted during the famous Vodafone case. So what happened in the Vodafone case was that Vodafone India's shares were sold by a company. The shares of Vodafone were held by a company in Mauritius. Substantial amount of shares by a Mauritian entity for tax reasons. So the person who invested and set up a company in Mauritius, that Mauritian company bought the shares of Vodafone India. Now, that person sold the shares of the Mauritian company to another person. Okay, and the government said, we want to tax it here. And then, of course, the cases went on and all. But eventually, the Indian Income Tax Act was amended to say that if the shares, as you can see on the screen, of XYZ company are sold and a capital gain arises, that will be taxed in India. When ABC and company, when the underlying assets of XYZ, the US company, are in India and they have a substantial value. And how do you define that? Okay. So now, income arising, I'm reading from the first line, income arising from indirect transfer of assets situated in India. So they're indirectly situated in India. What you're selling is a US company shares. Is deemed to accrue or arise in India and taxed in India. Indirect transfer means if it's an indirect transfer, which means any transaction where shares or interest in a foreign company or entity which derives its value substantially for underlying Indian capital assets, which means it has a big presence, in layman terms, it has a big presence in India. And that company whose shares are sold in the US derives its substantial value from India. Right? So what is substantial value? Condition number one, if the fair market value of the assets of the foreign company located in India exceeds rupees 10 crores, rupees 100 million. This is the first condition. And which means if it is less than 10 crores, then it is out of the ambit of indirect transfer, taxation of indirect transfer. So the asset should be a big company. It shouldn't be like a small company with 50 lakh assets. Now you're saying, oh, you hold a company in India, you own it fully, it has 50 lakh rupees of assets. They've exempted that. And the other condition is that foreign company derives 50% or more of its overall value from the Indian assets. So if there's a foreign company which has one company and one subsidiary in Singapore, a US company has a subsidiary in Singapore from which it gets some value, then another one in the UK from which it also gets some value, obviously it has a business. But it has one in India where it derives 70% of its value. Then when you transfer the shares of that US company, right, they will be taxable in India by virtue of indirect transfer provisions. And they'll be taxed as capital gains. And of course, here again, small holdings are exempted. So if somebody is holding 5% in XYZ, so if there's a person who's holding less than 5% or less in XYZ, say he's holding 100 shares, and he sells, A holds them and sells them to B, and it's only a small percentage of XYZ, then it is exempted. So how much time to go? 10 minutes. So we have the Q&A after 12:30 or within 12:30.
So we can extend because as long as
12:30 to 12:45 is Q&A. Thank you, Sanjana. You're very helpful sometimes. So how do you avail credit? So every country has its own process. So if tax has been deducted by India, from a US company, by an Indian entity from a US company and deposited to the Indian government, then, so like in India, there's a form 67 to be filed. No, sorry, this is when somebody outside India has deducted the tax from an Indian person. Okay. So, say ABC company is an Indian company. It earned some income from the US and the US company deducted the withholding tax as per the DTA provisions, tax treaty provisions. Then when it files its own return in India, it will have to do some formalities like file Form 67, and so on and so forth, and apply for credit of that tax which was deducted by the US company. And of course, there are similar formalities at the US end also. So this is a general rule that when the tax rate, mainly the tax rate of the tax provisions of the treaty are more favorable than the Indian Income Tax Act, then the taxpayer has a right or a discretion to pay the tax as per the lower of the two, tax treaty or Indian Income Tax Act. And of course, to apply tax treaty, this becomes a very big issue. TRC, you see, third line from the bottom, tax residency certificate is required to avail the treaty benefits. Because a lot of time, so even our clients get very irked when we say, please get a TRC from the person you're paying to, because we will deduct the tax according to the tax treaty with that country, let's say with the US. Only if you give us a tax residency certificate of that company saying that it's a tax resident of America. So it becomes cumbersome, but the reason behind this is that a lot of people do treaty shopping. They set up a small little office somewhere, say in say UAE or in a tax haven, and they say, I'm here, but they are not recognized tax residents of that country. So that government has not given them a TRC because they're just a brass plate company. They don't do anything, so they don't get a TRC. So TRC is also becoming a strict thing. It's a big thing now. So many countries, including Mauritius, they have stopped giving TRCs just because you've set up a company, unless you prove that you have a substantial business there. Okay, like I said in the beginning, just a bit touching upon expat taxation. I always imagine myself in a situation where I go to America to take up a job, right? Now, Indian guy doesn't know anything about the US tax laws. I end up in America, in the US, and now I'm about to take up an employment. Now, I would be petrified because I don't know the laws. How am I going to be taxed? There is a federal tax, there is a state tax, there is complexities everywhere in every country. So now what we are covering here is, very briefly though, is an American expat coming to an unknown, arena called the Indian income tax system. And now he's thoroughly confused. So just shedding a little light on it here in the slide. A US person who has come for an employment in India is an expat, obviously. His salary is derived from India. So therefore it is to be taxed in India because he's exercising the employment in India. Right? Even though he continues to be, say, a US resident, right? But he exercises the employment in India. Then, of course, employers will deduct TDS like they do for any other person. When the expat is working in an Indian company, salary payment will be subjected to TDS, right? And then another very important feature between the India and America tax treaty is that India and USA, unlike India and many other European countries, and this is something which, Arun, I think, you can help the US expat community working in India by maybe reaching out to the government through the Indo-American Chamber of Commerce to make sure that this, gets implemented sooner rather than later. So what is it? India and USA do not have a social security agreement. And therefore, the expat working in India has to be subjected to provident fund deduction. So 24% cost बढ़ जाएगी Indian company की. The cost will be jacked up by the component of provident fund. Although 12% is paid by employer technically and 12% by the employee, but actually it goes from the same CTC. And if you deduct it from the employee, his take home reduces. Okay, and then much as I hate to say it, the ground reality is that at the end of the employment, now the person wants his PF back. Say he comes for 5 years, works in India, PF is deducted, collected by the government. Now he says, Tata, I'm going back. Now I've got a job in Brazil. So when he goes back from here, that PF which is deducted not only hurts his pocket, not only hurts the company's cost, but also remains stuck. Because unfortunately, there's a lot of delay in in the procedures which lead to the release of that money. Okay, and then again, there's a rule that till he does not reach retirement age, which is 58 years, he will not get the PF back because he's not of retirement. So there's a lot of gray, and we've seen clients suffer a lot on this account. But luckily, a lot of countries, say France, India and France have a social security agreement, SSA. So the French people who are covered by the social security arrangement in France, they don't have to pay PF. So they are kind of exempted because it is provided in the treaty.
So, SC people are part of this.
Embassy people have a different status altogether. They don't even get taxed in India. So they have a diplomatic immunity, you can say.
The Americans or Americans, they get pensions. Where is it like from? An Indian corporate sector, there's no pension schemes here. Even after they're retiring. So that comes from the tax. How does that work? So that's just social security by the government.
No, are you saying pension earned by somebody in India, a US resident?
An expat who was working here in. Now, obviously, he's a big cost to the company, so he's sent back. But then he's retired, and obviously they continue to get pensions
From his country in the US. Yeah, that will be taxed only in the US. So there's a separate chapter in the treaty.
The American companies here, after retirement, they continue to get pensions.
No, but who continues to get? The Indian employees? See, the Indian employees get pension in India. Even if they get it from the US company, they are residents of India. So they have to pay full tax on their pension income. Full tax meaning they have to declare it in their tax return fully. There are no, straight deductions. So it gets declared as a pension income and you pay tax on it.
They do get the pensions.
Yeah, see, getting a pension is one thing. The taxability of it, whether it will be in India or the US, is another matter altogether. So we can talk on the side after this if you have any further doubts. Okay, the last line is also very important. So once the expat who comes to India, once he becomes an ordinary resident as defined under the Indian Income Tax Act, then his global income, including his income in the US, including if he has a property in the US which is earning rental income, everything is taxable in India. But luckily there's a tax treaty, so he will get the benefit of tax he suffers here. He will get the credit for that in the other country. But in situations where it is avoidable, one should avoid, for as long as one can, becoming an ordinary resident of India.
India holds a diplomatic passport.
No, diplomats are totally out of the ambit of this because they are not, they have immunity, like I said, they have diplomatic immunity. But if a normal person comes, say he's coming for an employment in India, I'll show you the next slide, then you'll understand the number of days better. So an individual is said to be a resident in India when he is in India, and this is tax resident, not under FEMA. So he becomes a tax resident of India when he is in India for 182 days or more in that financial year of India, 1st April to 31st March. So if an expat comes here, he lives for 182 days in a year, say he comes on 1st September, stays on till 31st March. So he's been here for 7 months, it's more than 182 days. He's a tax resident of India. But there is another layer. Once you become a resident, then one has to determine whether he's an ordinary resident or a not ordinary resident. So if you are not ordinary resident, or as long as you are not ordinary resident, your global income will not be taxed in India. The moment you become ordinary resident, you have to declare your global income in your Indian income tax return. And then, of course, treaty provisions take over for tax credits and avoidance of double taxation. So when does he become ordinary resident? It's a little complicated, but very important nonetheless. He becomes, firstly, you see the top two. Sorry, I missed out the part B, 1B. So even if a person, okay, is in India for 60 days only in a year, financial year, but in the previous 4 years, he has spent an aggregate of 365 days, then also becomes a resident. So somebody who was, say, habitually in India, coming every year, spending some time, and has spent 365 days in the last 4 years. Now, in this year, he comes and spends 60 days again. He becomes a resident.
So 365 days cumulatively, past 4 years, plus 60 days in the current.
Yes, yeah. Right? So, or 182 days in this year, you become a resident. So sometimes you think, oh, I've been here only for 70 days and I cannot be a resident. But you can be if you've been here in the last 4 financial years for an aggregate of 365 days or more.
It's 1 year out of 4 years. This is.
It means that, yeah. See, but it obviously 365 days is 1 year. But what they mean is, if you've been, say, 365 days in the year, then you become resident anyway last year. You understand? So that's how it works. So an individual is said to be ordinary resident when first you know how he becomes a resident. Like 182 or 365 plus 60. After that, you see, is he now ordinary? He becomes ordinary when any one of the below conditions is met, in addition to being a resident, which is 1A or 1B. He has been a resident in India for at least 2 out of 10 immediately preceding fiscal years. So if you've now become a resident, but in 2 out of last 10 years, you were a resident of India. So this year is 24, 25. You've spent, let's say the year is about to end. You've spent 185 days here. You become a resident. But in the last 10 years, you were a resident twice. Then you become ordinary resident in this year, in 24-25. By virtue of being a resident and being a resident again in 2 out of last 10 years. Now you become ordinary resident. Your global income is taxable in India. He is in India for a period of 730 days or more in 7 fiscal years preceding. So I'm sorry, it's either A or B. If you meet A or B, then you are an ordinary resident. So if you've been in India, no, actually, it's both. But you know what's confusing is the one you've written there. You see here, next to 2, point number, and just below any one condition. It should say both the conditions. We'll revise this and send it out. Nisha, revise this. There's an error here. Okay. So 2 out of 10, and he is in India for a period of 730 days or more in 7 years preceding this year. Both have to cumulatively met.
Applied for that fiscal. I think it's correct, actually. There's nothing wrong with the statement. Anyway, it's said to be ordinarily resident in that fiscal year if he satisfies both the conditions below. I think it's correct.
Yeah, it is correct. But I got a little mixed up because upper it says any one condition.
Okay.
That should say both. Okay, so dependent personal services. This is salaries. This again, it is taxable in India if you're running it from India.
Yeah.
But we'll read the nuances. Salaries and similar remuneration derived by a resident of US in respect of employment shall be taxable in the US unless the employment is exercised in India. Obviously, the US employer is giving you salary. If you're working in the US, it can't be taxed in India. Right? If the employment is exercised in India, such remuneration is derived therefrom may be taxed in the US in the below cases. This is interesting. It can not be taxed in India also. Although you're getting it, you're exercising your employment in India. What are the conditions? the employee is present in India for a period of periods not exceeding 183 days. So the person is not coming to India for more than 182 days. The remuneration paid by or on behalf of an employer who is not resident of India, which here means US, and the remuneration, or could be any other country. Maybe your employer is in, what do you call it, a associated concern of your US employer in Brazil that is paying you, but the Indian company is not paying you. The remuneration is not borne by a permanent establishment or a fixed base, which is in India. So you are not here for 183 days. No employer in India is bearing your, and no PE in India is bearing your salary. So then it is not to be, it will be taxed in the US because you're a US resident, right? And not in India, is what I meant. And of course, if you're employed on a ship or aircraft, which is being operated like, pilots and all, they only get taxed where the enterprise, which is doing the operation, is based. Like United Airlines is in the US, pilots of UA will be, United Airlines will be taxed in the US. And same goes for shippies. So if your board of director of India is on the board of directors of an Indian company and you're getting a director fee, it is taxed in India. Only in India. So there is no double taxation. It will only be taxed in India as per the treaty. It's not like US will again tax it and all that. That is it for today. Thank you very much, everybody, for your patience. We are open for Q&A now. And of course, people who are attending online can also ask questions. Nisha, I hope the mic is working.
Yes, sir, it is.
Usually it doesn't, so I'm a bit worried.
And let's give a chance first to the people who are online if they have a question. Can they just speak up if they have a question? So
Yeah, they can speak up. They're audible.
to the attendees, guests who are online, if you have a question, please just speak up. So meanwhile, while they're probably looking for questions, I do have a question and it's slightly digressing here. How about income from ESOPs? So the US parent company issues ESOPs to the employees of the Indian entity. Those are, of course, US shares. And once they're vested, the Indian employee sells those shares and derives some earning from it. How is that treated? So those are US shares.
It's easy to guess who you're talking about right now. Yeah. So because you are employed by the Indian company, even if you get stocks in the US company, they're taxed in India.
The tax treatment. Okay.
Because you're getting them by virtue of exercising your employment in India.
Got it. And what if there's withholding in the US while the shares?
Then the DTA will come into play.
Okay. So you can offset.
Yes, you can offset. Any questions, please?
Practical difficulty by branded Austria. The social security agreement, India and Austria. We have been resident in India for the last 4 years.
4 years. Okay.
Resident and employed in India. Whenever I ask you after filing returns, they don't, people hesitate in telling their income in Austria, whether rent or anything. Okay, that's none of your business.
No, that's fine. You should take it in writing from them.
Taking it, that's none of my business.
If they give it in writing, I mean, you're not supposed to investigate their income. You're just filing their taxes.
Many of the clients that they own this problem.
Yeah, it's to some extent, it's a human tendency. We know, Indian clients, if you tell them you have to disclose your bank account in the US or in Austria or wherever, they're very hesitant. So, I don't want to disclose, but they're supposed to. When you file your tax return in India, you have to disclose all your foreign assets, including your foreign bank accounts. People are hesitant, but so be it. We cannot help it. We can only advise them to follow the law.
Safeguards, helping.
Yeah, as far as the US is concerned, it is helping. But there are many other countries, which don't have a similar regulation.
Hi, this is Kanchan from Vishara.
Hi, Kanchan.
Hi, sir. So I have a question here, like if there is a resident of India, and is there any limit of getting any gifts from some relative or some non-relative in US, like maybe in cash or in kind?
So you are based in the US. The
I'm not talking
recipient is in the US.
no recipients in India.
Okay, so a US resident, tax resident, wants to gift some money to an Indian tax resident.
Yes, yes.
Right. And now, can you repeat your question?
Yeah, so is there any limit like of receiving that much, and how the taxability would be treated in India about receiving a cash gift or maybe kind gift in
Okay.
India?
So if you give to a blood relative in India, and blood relative is defined under the Indian Income Tax Act.
Mhm.
Broadly, it includes your lineal ascendants and descendants, which means your father, grandfather, maternal grandfather,
Mhm.
so on. Your parents, brothers and sisters, which, in our local languages, chacha, chachi, mama, mami, bua. If
Mhm.
you're, if you're receiving from them, if you are their bua, if the
Mhm.
recipient is your nephew. So basically, we'll send to you separately the eligible blood relatives, okay, who are
Mhm.
exempt from tax on gifts received by them. So we'll send you that list separately. It's a very long list.
Okay.
So if you send to a blood relative in India, then it is totally exempt and it has no limit.
Okay. And do we need to like have disclose that number somewhere in our returns?
Who the recipient?
Recipient, yes.
Yes, the recipient will disclose the gifts he has received. But let me also tell you the other part. If you send it to a non-blood relative, then it is fully taxable. There's a small exemption of rupees 50,000, but that is per person from all people he has received gift from. So a recipient cannot receive more than 50,000 without paying tax. So if Arun has given me 45,000, will you give me? And then Kiran wants to give me another 10,000. Then the 10,000 which Kiran gives to me will take my total to 55,000, the recipient's total. So I'm exempt only up to 50,000. So on the 5,000 which are over and above 50,000, I will have to declare in my income tax return as my regular income and pay tax on it.
Got it.
But if I receive it from a blood relative, it is non-taxable.
Any number of amount.
Any number.
Okay.
But let me also, for your benefit, let me also tell you that when you send it from India to a blood relative abroad, then other regulations come into play, like FEMA, RBI regulations and FEMA, and it gets subsumed in your overall liberalized remittance scheme, LRS limit. And it's subjected to TCS and all that above a certain limit. So it's not so
I
easy
think
when you
there is
send
a
it
limit
from
of
India.
Yeah, there is a limit of 7 lakhs in that case, I believe.
Yeah, beyond which TCS kicks in at 20% now.
Yeah, got it. Sure. Thanks.
You're welcome.
We have a question from Mr. Vipin Jain. He's asking, in case TDS is deducted in India at the rate 25% on FTS and that is taxable at the rate 20% in USA, then in that CA, what will be the
In that case, it's very,
what will be the tax benefit in USA?
it's very simple. Because the US tax rate is lower than the withholding tax you have paid in India, you will pay zero tax in the US. But you will not get a refund. If you pay excess, you don't get a refund. In India, you pay 25%, too bad. In the US, you had to pay only 20%, but you got credit only to the extent of tax suffered. But not beyond the tax payable in America. So you don't get a refund of that 5% in either country.
He has one more question. Interest on PPF is exempt in India. Will that remain exempt in USA in case of tax resident of USA whose global income taxed in USA?
No, it will not be. It will not be exempted in the USA.
Say you want to invest in India, like some sort of LIC. Regular people every year, 5 lakh, 10 lakh rupees. The majority will be taxable in India or in USA.
He wants to take an LIC policy, you mean?
Yeah, the online business.
Okay. So US residents,
He's NRI and settled there.
is he citizen of USA?
Yes, he's.
Oh, I doubt if he is even eligible to get a LIC policy.
Yeah.
Yes.
Yeah, please. Can I answer this question?
Yes, sure.
So till 5 lakh rupees, which is the normal norm in India also now, will be tax free in India. And post 5 lakh, and the majority as per DTA, double taxation law in Philippines, 10% of the gained income that will be taxed. So for example, he pays 5 lakh for 10 years, 50 lakh he has paid, and he's getting a majority of 1 crore. So in India, there will be no tax on that. And in US, the tax will be on 50 lakh, the incremental value, 10% of 50 lakh he has to pay.
And if you buy more than 5 lakhs,
Then it will be taxable in India also, and there also.
so he has to pay tax once.
So that tax will be.
Like in India, suppose you pay 10 lakh. That means that 2 crore will be maturity value, which is you say taxable. So in India, it will be taxable on maturity of the profit gain. And suppose he pay tax here, then he has to pay tax in US.
No, then he is not supposed to, because here it will be 20%, there the tax is 20%. So we will not get the refund, so only it will be taxed.
Okay. So after paying the tax, the money will go to, you can use that money in US without paying any tax.
So if I may suggest something, maybe you can email your query to us and we'll give you a detailed reply. No, because it also involves, in my opinion, LIC giving a policy to it's like a foreigner. It may be a person of Indian origin. So we'll, of course,
Indian origin. They are only eligible.
so the person you're talking about is an Indian origin person.
Born in India, found in
Yeah, so that is Indian origin.
Not.
So I think it's better if you send us the query, we'll give you a proper reply. I mean, with due respects, I'm sure you've also given a proper reply.
That in mind.
And
We can discuss it after.
Profit is taxable, the total amount is taxable. So he paid tax.
It goes same as like an Indian resident. So I think it has become taxable now, more than 5 lakhs.
No, sorry.
Yeah,
I'm
we-
saying he is paying more than 5 lakh. Both the total amount is taxable, whatever he has paid is not taxable, the profit is taxable.
Profit. His own income, own money he has given can never be taxed. It's only the profit which can be taxed. The excess he gets will be taxed. But I'm not sure. I'll have to check and send you a reply later.
We have one more question from Mr. Vijay Rajendran. The salary paid to a US citizen working in India will be taxed in full in India or after SST deducted there. SST deducted net salary.
Repeat the question.
Salary paid to a US citizen working in India
Working in India. Okay. US citizen employed in India earns a salary from India. From the Indian company, right? Or from the US company?
from the Indian company, I suppose.
Then how is SST deducted in the US? It must be, maybe, Mr. Rajendran, can you reframe your question? Or maybe you can even ask us verbally. You don't have to necessarily type it.
Sir, I mean, US company pays a US citizen who's actually deputed in India. He gets a salary from the US company. So I think there are case laws which say that you can deduct the social security tax and offer the net sum alone as taxable salary in India. Does that situation still continue, or should it be offered at the gross level without allowing for social security tax to be deducted?
See, prima facie, the entire salary is the income. Okay, social security is just a deduction which is going to his own account, right? And getting accumulated, say, in his account with the social security agency. In effect, he's earning the entire thing. But to be honest, this is a question which requires further deep study. We will take your question. Please make a note, Kiran. And we'll give you a reply after studying it further.
Thank you,
I
sir.
hope that helps.
Thank
You're
you
most
so much.
welcome. Most welcome.
Then Mr. Vipin Jain is asking, is there any wealth tax in USA on Indian property inherited by US resident from his parents in India?
Is there any wealth tax in USA on?
Indian property inherited by US resident from his parents in India.
Oh, okay. We are not aware of the wealth tax provisions in the US, but I can tell you that when wealth tax provisions kick in, they apply to your property globally. So like many years ago, there was wealth tax in India, and that was applicable to all your assets, whether in India or abroad. So I suppose, rationally speaking, that should be the position there as well. But again, this needs to be checked. Maybe you can do this one. We'll give you a reply. Do we have her email? Will we get the email ID? Of
They have registered online. We have to check something.
Can you leave your email ID, please, Mr. Jain? Okay. Let's see, it's not.
And we have one more question from Dr. Deepshikha Pandey.
Mhm.
If US resident sends money to Indian relative as gift, what will be the tax implication?
US resident sends gift to Indian relative.
As gift.
Okay, if it is covered by the definition of blood relative, as per the Indian Income Tax Act, there will be no tax in the hands of the recipient. And if it does not fall within that definition, then it will be fully taxed at normal tax rates.
Okay, thank you.
Like I said earlier, beyond 50,000 rupees in a year.
Okay, thank you.
Yeah, I think we'll put out a last call for any questions. And if there are none, then we'll close this session out.
I have a simple question.
Yeah.
Suppose within amount and limit, like you well, the interest rate of 1%, 2% in India, then people are getting 9%. So how to translate some money and make the profit within limits?
Within which limits?
Limits means how we can technically bring the money from USA, suppose my relatives are there, and India, bank FD or something, so that just the transfer of the money makes some profit and within the limit of taxes. I'm just asking simple.
Different kind of arbitrage.
So it is possible, but so your relative is outside and you are in India, you're saying. Your brother is there, he's got a lot of money, and you want him to earn 8% interest on his fixed deposits here. That's the question, right? So, well, tell him to gift it to you and you invest on his behalf. That is the best way to do it.
Even for NRE account. NRE account.
Yeah, NRE accounts have a lower rate of interest. NRE, what is the current rate on NRE? Kiran, would you know?
5 to 6%.
5 to 6%. 3-4% usually. It hovers around that.
FCM.
Huh?
NRE has FCMR has its.
See, NREs typically, so see the interest rates keep varying in any country, any economy. So typically NRE deposits give you a lower rate of interest nowadays. That is
NRE isn't, where the money is coming from external sources, but that is an INR. They get more.
So you can see the immediate fundamental problem with that approach. So we are talking about a situation where the non-resident is opening an account with his own name.
Yes.
In one of those 4 categories, NRE, NRO, CNR, SNR, or whatever. Right? So,
No, but I'm talking about NRE.
Sure.
Because NRO has a different tax implication.
Sure. So the only larger point I'm making is that he would probably want greater flexibility in the sense that he may want to explore other kind of schemes which other banks are running. So the money comes in on the gift, and then he puts those money into bank accounts. He has the whole market in front of him. Whereas his brother, they only have those 4 categories, as you say, NRE is probably the only option left for this. So from his objective point of view, maybe we have more flexibility in what
to be honest, we don't really know the objective, but yeah, there are various scenarios which can be explored.
The benefit from the interest rate arbitrage. The differential interest rate which he's talking about, he wants to exploit it to the advantage. And from that point of view, that objective will probably be well served in my opinion. If the money is given by the Indian resident in your own banking system.
But how do you repatriate the earnings back?
So then you have to see the tax implications also.
Should we say tax?
Then in NRE, there are no tax implications, but if he will invest in every, there is a tax implication. So that will be taxable. And then you have to see that currency fluctuation.
Yes. I think the maths has to be done. Yeah.
That I will make.
There you go.
Eventually, yeah, it depends on the objective and the arbitrage you get between, various options.
The tax implication.
Yeah. Arbitrage, let's say arbitrage post-tax.
Repatriation.
Tax implication. NRE is very easy for him.
For him, he will be already from India. He can do any FDI and everywhere. When he reach that table, ask money back. He have to flow back.
May I suggest if we can continue this conversation offline? There is one more last question coming online.
Question. It's got some details.
You brought some clarity.
Yeah, I
to the matter.
include about tax benefits and like how things goes here.
So it relates to the same question,
No, it's got nothing, it's got to do with filmmaking and production.
filmmaking and production. Okay, so,
There's one more question.
yeah,
I'll surely be able to help. I'll give you this answer.
so
So, yeah, I mean, I need to know whether you have a company, what type of entity you have here.
Exactly, I'll send you all details.
Yeah. I'll
so
be able to help.
So we have one more question from Mr. Gopinath Das. He says, if the operation of US India company is shut over a period, how tax be levied in that holiday period?
Is shut meaning it has discontinued operations for a bit, I presume, right? Arun,
So
what do you think?
I think the question is if it is suspended over a period of time, so it was operating, then suspended, then resumed again. So how is the period of suspension treated from a tax perspective?
So firstly, I don't quite understand the term US India company, US-India company. So are they saying US company which has a subsidiary in India?
I think
That's not clear.
I think that's.
But if that is the case, then it is an Indian company for the purposes of the Indian tax laws.
Right.
And all the taxes will be applicable like they are to any other Indian company. And if operations are discontinued, it doesn't matter because during that period, there'll be no taxable profits and therefore no tax to pay. And as and when they resume and they start earning taxable profits again, they'll pay the normal corporate tax applicable in India.
So with that, I think we'll bring the session to a close. Thank you so much.
My pleasure. My pleasure.
Thank you. Thank you.
Thank you.
Everyone for joining in, both virtually and in person. I'm extremely thankful to all of you. Thank you.
Okay. Thanks, everybody.
Thank you. Break for lunch?
Yeah, let's break for lunch.